Welcome to the Steps to Investing podcast, helping aspiring investors get to grips with the world of finance and investing. This week on the pod, Ben Seeger-Scott from stockbroker Tilney Group on the driving forces behind current market optimism and why inflation will likely remain low for the time being. Ben is a multi-asset portfolio manager overseeing £7 billion in investments. Hello, I'm Simon Longfellow.
And I'm Marcus De Silva.
And welcome along to this week's podcast. What stories have been piquing your interest this week, Marcus?
Yeah, I think one of them out there that was very interesting is for those who are seeking a little bit of income in their investments, and specifically the income that you might get from shares, so that's dividend income. So funds that operate in this area, they're known as equity income funds, have been popular for those seeking yield in the past decade because mainly of really low interest rates. And these things are equity income is popular when saving rates are low, and income from bonds are really rubbish because it means that the extra risk that you're taking in shares just seems that little bit more attractive, especially when you're getting paid a yield and you've got this potential for capital growth. Now, 2020 was a really tough year for dividends, right? Companies pared back a lot of their payments in order to conserve cash during the crisis. They didn't know how long it was going to go along. And by the end of 2020, globally, we saw $220 billion worth of dividends had been cut. So that's a 12.2% decline. It's absolutely massive. And they're according to figures from Janus Henderson. Now, the UK was even more grueling, right? We're a big dividend paying market. We're known for that. And over the course of 2020, dividends fell 44% on a headline basis to 61.9 billion paid out. So that's the lowest amount that's been paid out since 2011. So you can see we were put back quite a number of years, and they're figures from Links. So given this terrible dividend picture, you would expect these falls to be reflected in funds that pay out a yield from dividends. For regular, normal, open-ended funds, the ones that most people invest in, it spelled disaster, really. So if you look at the Investment Association's Global Equity Income Sector in 2020, only 24% of funds managed to maintain or grow the income they paid out to investors. And when you looked at the UK equity income sector, only 4% of funds managed to maintain or grow their dividends. What do you think happened in the investment trust space, Simon?
I haven't seen these numbers, so I would be guessing, but given their revenue reserve structure, I'm guessing a tiny number cut their dividends.
You're absolutely right. So in the AIC Global Equity Income sector, 100% of them maintain or grew their dividends. And in the UK equity income sector, where it was far more brutal, 94% still managed to maintain or grow their dividends. So I just thought that was remarkable, and you're absolutely right. It's because of this revenue reserve structure, which is really just a rainy day pot. So they can squirrel away up to 15% of the income that's paid by companies to the fund managers. They can put 15% of that aside and save it for a rainy day. In normal open-ended funds, you've got to pay everything out. So that's why they don't have this pot, which is why they don't have this ability to maintain or grow dividends when the underlying companies are cutting them. So I just thought that was quite some interesting figures there.
It is, and of course with an open-ended fund, because they pay everything out, when in the good years they pay lots, in the bad years they pay much less, and of course it's that smoothing effect of investment trust that this pot allows. So your income is actually much smoother, which is of course very helpful if you need a smooth income flow. Anyway, what have I been doing this week? Well, I'm going to shamelessly plug my blog post this week, all about financial goals. It's on the Steps website now. What I've done is taken a look at the different types of goals and what influences whether or not using investments to meet those goals is a good idea, because it sometimes isn't, frankly. I also take a look at some of the interesting survey results which have come across our desks, and this is telling us what people are saving and investing for right across the UK. Some really interesting numbers. I won't give it away. Check it out on stepstoinvesting.com. It's on the blog page. Okay, well, on with the show. As they say, in a moment, we look at the prospects for the rising of prices of the goods and services that we buy, inflation, and why technology companies could be in for a bit of a bumpy ride with, as I said, Ben Seeger-Scott from the Stockbrokers Tilney. But before we do that, let's catch up on what's been happening in the news first. And as ever, let's start with markets.
Sure, yeah. So I think in markets this week, we've generally seen two bits of news from our American friends across the pond that have been driving some broad optimism really across global markets. And I think the first thing to say is that Mr. Biden has managed to get the final approval from Congress of his enormous $1.9 trillion stimulus package, fiscal stimulus package, which is going to include $400 billion in the form of $1,400 direct checks to Americans earning under $80,000 a year. We're also seeing $350 billion for state and local governments and a whole bunch of other stuff that should really boost a strong economic recovery this year. In fact, the Organization for Economic Cooperation and Development, the OECD, is predicting up to 6% economic growth for the US economy this year. Second thing to note was an inflation report in the US. The latest Consumer Prices Index, CPI reading, showed that when you exclude the really volatile stuff like food and energy, prices were up year on year 1.3%. Now, while this is kind of in line with what analysts were expecting, it more importantly is showing that for the moment, inflation is being contained, which is calming fears that could it be imminently let out of the bag and cause central bankers to start doing things with monetary policy like raising rates, which could put a brake on the economic recovery. So both pieces of news, pretty positives, and they've sent global equity markets higher and settled the bond markets a bit for the moment. In the UK, we saw in March spending rise following quite a weak period at the beginning of the year due to lockdowns. So that was pretty positive. And in Europe, we have the ECB that are meeting later on today. They're going to be discussing any changes to monetary policy, and in the press conference afterwards, people will be looking to the European Central Bank's president, Christine Lagarde's signals for hopefully that bond rates are going to be kept low by continuing quantitative easing programs, money printing, and also that she'll keep a lid on interest rates for the moment as well. All in all, the S&P 500 is up 80 points to 3,898. The FTSE 100 is up 85 points to 6,729. The Stock 600 is up 12 points to 422. And the Nikkei 225 is up 492 points to 29,211. Simon, what have you got?
Let's start with quality high street retailer John Lewis. They have said today that it does not expect, or they don't expect, should I say, all their stores to reopen when the lockdown restrictions ease next month. It had previously said it was considering closing up to 8 stores just to try and cut costs, but these new closure proposals would be in addition to those already announced last year. The group actually made £146 million in profit in the year to January 2020, but this year that swung to a £517 million loss. Chairman Sharon White said that the closures would be painful, but that the reality was that some areas could just no longer support a John Lewis store. Now, in other high street news, embattled retailer Marks & Spencer is set to start selling clothes from other rival brands in its website in spring this year. Now, those brands include Hobbs, Joules, Phase 8, and the move just forms part of their transformation program. They're basically just trying to increase online sales. Now, according to the latest company results, online clothing and homeware sales were up 34% in the period. But in that same period to the end of September last year, losses amounted to just shy of £88 million. The new clothes will appear alongside other M&S items, while its own classics and limited ranges are being cut. Shares in the retailer are up 20% this year. And finally, German sportswear manufacturer Adidas has said it will double its payments to shareholders over the next 5 years. This week, the company unveiled a plan to increase revenues by about 30%, so up to 30 billion euros a year by 2025. It said that it would achieve this plan through increased sales online, but also selling more in its own stores rather than through other retailers. Shares in Adidas are up 1.6% this year. Okay, so now on to our interview. And this week, Marcus spoke to Ben Seeger-Scott from the stockbroker Tilney about, amongst other things, 3 investment opportunities based on his view of economic recovery and inflation.
Now, we often talk about asset allocation as one of the core tenets of diversification. So that's the decisions around how much of your portfolio might be in shares, bonds, cash, alternatives, etc. Well, our guest today is a professional asset allocator and fund selector, overseeing multi-asset portfolios worth around £7 billion for his clients. So I thought I'd ask him about global markets, where we are with the reflation trade, how the US and UK are faring, and where there may be some opportunities across the asset spectrum. So I'd like to welcome onto the pod Ben Seeger-Scott, Head of Multi-Asset at Tilney Group. Ben, a very warm welcome to you.
Thank you for having me.
Let's start quite broadly. The past year certainly set some pulses racing. We saw a big crash on the pandemic, a sharp recovery on unprecedented stimulus programs, and then a rotation into more cyclical parts on vaccine news. So where are we in terms of global markets right now?
Great question. And as always, it pays to separate out markets from economics. Obviously, economies with the UK having contracted, GDP down almost 10%, not quite as bad, but bad numbers elsewhere. Economically, we're still moving through towards recovery, but markets have moved some way ahead. It's interesting, through the course of 2020, global markets were actually up year on year. And that speaks to the power of both optimism, but more importantly, stimulus measures. And it's been the first time for a long time that we've had monetary and fiscal policy both in effect. And obviously more of that still coming through, particularly the US fiscal program, more recently, some of the central banks talking up some of that enthusiasm. So where we are now is actually, there's quite a lot of optimism in the price. That's obviously a good thing, not implying that we're necessarily headed for a fall, but it does mean we need to be a little bit more nuanced, I think, in terms of where markets are likely to go from here. And my sense is that markets are broadly expecting long-term growth and for the economic cycle to roll over into a new cycle. But that said, I think there are still some risks in the short term. Quite high on that risk register is the potential withdrawal of stimulus. And you'll notice recently that central bankers have been going at quite significant lengths to try and signal that loose monetary policy will be here for a while yet. Some similar noises from governments. It's a bit harder for governments though. So on the one hand, if you're the Chancellor or Treasury Secretary, you want to put out the message that you are a responsible borrower. So not just going to keep on borrowing forever to fund everything. At the same time, you need to keep markets relatively happy that you're not going to turn the taps off. So I think where we are at the moment, there's a good outlook, particularly around economic recovery. But I think because a lot of the economic reopening, particularly in Western economies, is still some months away. We've had a difficult 2020, particularly bad Q4, with a lot of Europe and the UK going into lockdown. A lot of those businesses, particularly in travel and leisure, rely partly on the festive period, but also last summer's reopenings and some spring reopenings now. I think there's a chance that economics get a little tougher before they get better. So I think we'll see rising unemployment and increased business failures before we move through on the other side. And that in turn could have an impact on sentiment. So in all, markets are in a good place. I think the outlook is positive, but it could well be bumpy.
Okay, one of the big sort of rotations that we saw at the end of last year was into these more cyclical assets, as I mentioned. Where do you think we are in terms of inflation and economic growth? I mean, do you think that's going to come through? And do you think these reflation trades, this idea that you're moving into assets that would benefit from inflation and economic growth, are the right place to be?
Short answer, yes. Longer answer, it's complicated. And I think certainly inflation is something that's very much on my radar, particularly medium term inflation. And I think a lot of people, we've been used to best part of a decade now, we've been used to not really having sustained inflation. And people forget just how much damage and how much inflation can erode the real value of assets over time. But I think all of the criteria are now in play to see inflation coming through. Obviously, we've had even more extreme levels of monetary policy stimulus. And many people say, well, we had that post-global financial crisis and it didn't lead to inflation. I would counter it did, but rather than being inflation in sort of consumer goods and services, came through an asset price inflation and really drove a lot of markets through the last 10 years. What we have now, though, we have extremely supportive monetary policy combined with fiscal policy, and that's what's been missing from the last economic cycle when we had periods of fiscal austerity. Now we have both of those forms of stimulus. I think there's all sorts of reasons to think that some fundamental drivers as well will help push inflation from, for example, companies looking to move from an efficient but fragile supply chain and just-in-time processes to a few more robust processes that could lead, for example, to more onshoring, more backups in terms of their supply chain that adds a bit of cost as well. So if you've got monetary stimulus, fiscal stimulus, and other fundamentals, I think that could certainly lead to inflation on the medium term. And I separate that out because I think a lot of people will look at just the CPI year-on-year numbers, just a backward-looking measure, and say, well, inflation is low. If you look at that, we do expect it to pick up and maybe get quite punchy this year, largely for base effect reasons. Remember, for the next few months, year-on-year, February, March, and April last year, we had very sharp falls, particularly in the likes of the oil price and energy prices. You'll have that feeding through on a technical level. So if you watch the news, may well see inflation remains low, spikes up because of base effects, and then drops back. And people say, well, that's ridiculous. Why do you think inflation is coming through? You look at the economy, as we just said, we expect there to be slack for a period of time too, quite high unemployment. So why would inflation come through under those circumstances? And the answer is it probably wouldn't, certainly not in the short term over the next couple of years. But I think as businesses start to rebuild, as we have the next economic cycle, the longer term measures to me do seem inflationary. And you need to remember a lot of asset prices price in inflation on the medium term. One of the key measures that we and others look at, for example, your 10-year break-evens, that's the average of inflation over the next 10 years, or even the five-year break-evens. That's what do we think inflation is going to be like for the next 5 years from 5 years time, so 5 to 10 years in the future. And those are the sort of areas that inflation starts getting priced in to assets. So it's that medium-term inflation and inflation expectations that I'm looking at. But I certainly do think inflation is starting to build, and it's something that I'm considering in the portfolios that I run.
Okay, well then, who do you think in terms of the assets, the winners and losers will be in this reflation?
Well, anytime you have inflation, your mind immediately goes to real assets. So I think in the more nuanced parts of the portfolios, looking at elements such as infrastructure, maybe even for the right type of investors, a little bit of property. In fixed income, that leads us towards TIPS, so US Treasury, inflation protected securities, where you have that automatic uplift, and really the value of those instruments reflects to a greater or lesser extent the difference between expected inflation and what gets realized. So as inflation expectations start to build, I think those asset prices will do well. Now, if that leads to rising base rates, that won't necessarily help. But I think what we're likely to see, particularly given the rhetoric we've had from the Fed, the Bank of England, and the ECB, if you have rising inflation expectations, but central banks have signaled that they're willing to keep rates low and they wouldn't react too aggressively, I think that could signal, if rates hold relatively low and inflation picks up, those sort of inflation protected securities can do quite well. And when I look at the markets, it's the coded signals from central banks that you look for, talking about the symmetrical nature of inflation targets. That means they'll let it run a little bit hot just to try and offset. So average inflation targeting and allowing a bit of catch-up inflation And those are the signals that we've heard. And then, of course, more broadly, I think if you look at equities have a solid ability to allow to adjust for inflationary pressures, because these are businesses. A lot of those businesses can pass through higher costs to their customer base. So those are the areas that I would tend to look at within equities as well. Potentially, if we have a value trade coming through, particularly as yield curves start to steepen, potentially there it could be a good environment for value names, and maybe a little bit of a headwind for some of the more growthy type names.
Why is it that the growthier stuff like tech doesn't tend to do so well in an inflationary sort of interest rate rising environment?
Well, I think in some sense it's a relative effect. If you look at value versus growth, particularly tech, value names are just more cyclically geared. So as the economy recovers, then you expect them to generally do better because they have a lot of operational leverage. Things like banks as well do well from a mechanical point of view by yield curves, because if you're lending long and borrowing short, which is the business mode of most banks, then a steeper yield curve basically gives you more profits. But looking more in isolation, one of the reasons that tech and growth tend to be sensitive to rates is for the technical reason around discount rates. So if you're a growth stock and you're largely being priced off your future earnings growth, each subsequent year of growth, you discount by some amount. There's a discount rate in the market, and that discount rate is normally tied to interest rates. So when they're very low, the discount applied to your future cash flows is very low. So the present value of those future cash flows in technical sense are that much higher. So if the expected future interest rates start to increase, then you have a greater discount on those cash flows in the future. So that's one mechanism through which tech stocks can be very sensitive, or slightly sensitive in some regard to interest rates.
Ben, can you just describe what you mean by the yield curve and when it steepens?
Yeah, absolutely. Yield curve is something that we focus on a lot, but perhaps don't do a great job of explaining. So the yield curve is basically how much it costs, or if you look at something like government bonds, what the yield you get on government bonds is at different time points, depending on how long you're borrowing for. As with all things, exactly like if you're trying to borrow from the bank, if you want to borrow for a year, it's one rate, normally a little lower. If you want to borrow from the bank for 10 years, it tends to be a little bit higher, because no one knows as much what's going to happen over the next 10 years. It's a lot less certainty than over 1 year. So you demand a higher annualized rate. So when we talk about yield curve, we look at, for example, if we look at the UK, we look at government bonds, what they yield, say, if it's a 6 month, a 1 year, a 5 year, a 10 year, a 30 year, and it tends to be upward sloping. So we look at that for a variety of reasons. If you're a bank, for example, the rates at which you can lend and borrow are often tied to those or related to those. And that's where things like net interest margins operate. So if you can, for example, if you're a bank and you're lending on a mortgage at 20 years, and the going rates on mortgage are say 5%, and you're using money from borrowers, depositors, if you're only offering depositors 1%, then your net interest margin, that the amount you're making off that difference, is around 4%, because you're often using deposits, money that you've got raised from equity markets, bond markets in the short term to fund that in the short end, and you're using the longer term to lend out. So that's net interest margins. The yield curve itself, we'll often talk about the steepness. All that means is how much higher are long-term rates than short-term rates. Often we talk about the 2s, 10s. What that means is what's the difference between a 10-year government bond and a 2-year government bond. And that gives you some idea of just how steep it is, how much higher they are in the future than they are in the short term.
Okay, well then let's move to the US. I mean, it's quite tech growth heavy, and that made it a bit of a success last year amid the pandemic. Is it going to have problems this year or potentially the year after as a bit of inflation starts to come through? Is it the place to be?
Well, I think there's a risk you don't invite me back on the podcast if I keep saying, oh, it's complicated, and not give straight answers. And I've got no interest in getting into politics, but I would say it's nuanced. The US, as you rightly say, the US is dominated by mega cap tech stocks, and I think they may come under a little bit of pressure and start having these headwinds, both from a rising interest rate environment, from a changing of the stock cycle. Let's be honest, if you haven't got a Netflix subscription now, having been through lockdown for 12 months, you're unlikely in the next few months, say, as things open up, you can go back outside, you can go to the pub, you can go to the park. Then you're not going to be saying, now's my time to get a Netflix subscription, right? So I think part of it is specific to COVID. Part of it is related to inflation and interest rates. But I think you might also see a rotation. So the US market doesn't look terrible when you get down to a granular level. It is those tech stocks that are leading markets such as the S&P 500 to fresh highs and pushing the valuations relatively high. But if you strip out, for example, the top five, so dominated by tech, what people have called, sort of, rather than the S&P 500, the S&P 495 doesn't look quite so expensive. So I think, yes, at headline level, you could see some pressures in this part of the market. And because the US market overall is a little bit more insulated from the global economy, that's helped it do well through the downturn. But you might see areas such as the UK, Europe, and emerging markets on a relative basis. I think you could see a period of outperformance. But that's not to say there's no value in the US. I think once you get outside those mega cap tech stocks, there's still plenty of good businesses out there. It is one of the largest markets simply by opportunity set. So I think at a headline level, just looking at a market cap weighted index, there could be headwinds, but there's lots of opportunities within that. I think one of my biggest concerns in that area does relate to tech stocks, but it's not to buying those tech stocks themselves or their innate performance. My concern is that if we do see some of the valuations of tech stocks start to come in, obviously we've seen a little bit of that recently, and ever since we started to have the good news from November onwards. My concern is if those valuation adjustments and start to come in, if that causes a broader rout in markets. So if it spooks the market, that could be a little bit of a risk. But overall, the US does have opportunities at a market cap level. I think because of the mega cap tech stocks, they might face a little bit of a relative headwind in the near term.
I wanted to get into another potential headwind for tech, and that's the potential for a run-in with regulators and politicians. I mean, we saw the EC getting pretty serious about what they wanted to do with tech, and Margaret Vestager there. Do you think this is a broader theme, and do you think tech faces a bit of a run-in with, politicians in America?
I think globally tech stocks can be are starting to face the heat, and it's somewhat ironic. A lot of these quite a long time ago now, admittedly, but certainly their mentality has always been, I think, my view is around disruption. They've always, a bit like Tesla, they've always felt they're the little guys taking on big bad industry, and now almost overnight they've woken up and found that they are now the big titans. And I think there will be a little bit of an adjustment there. When you're a startup, this concept of move fast and break things, you can't do that when you're a large company. You're now subject to regulations, rapidly trying to catch up with what you do. I think they might find themselves in the spotlight. How much damage it'll do, I don't know. I think you see globally, particularly when there's going to have to be a reckoning, a lot of these debts are going to have to be paid back. So people say we're likely to see in the future slightly higher tax rates in an effort to rein in some of the borrowing. And it's always been the case, not just with tech. But you look around the world, you look at banks. Now, I know the global financial crisis added a different element to that. But you can look at banks, you can look at fossil fuels, oil and gas, as we had here in the UK. Anytime a company is seen to be making supernormal profits and profiting massively, then I think you become a target for a windfall tax. And I think it's quite clear that tech stocks have done very well out of COVID-19. So I think they will come under pressure to return some of that benefit that they've had through things like taxation. I think there are political questions around privacy, around where these companies pay tax. Some of the points around news flow, particularly as we're seeing in Australia and in Europe, paying news providers and journalists for their content. I think there is going to be a little bit of a reckoning But I think that's more of a sort of maturation of tech stocks, of the internet and all these other aspects coming through. So I think it's going to be a change over time. I don't see a big bang event. I don't see regulators going in, breaking them up, and basically ending the party. But I think as these tech companies mature, they'll find what every large industry has over time. Increasingly, you'll just have to moderate your activities and pay some elements back.
Ben, it seems as if the UK has been sort of, as the market has been out of favour for a fair bit of time. Do you think it looks attractive now, given that it's got a bit of a weighting towards cyclicals, and our vaccine programme has been pretty rapidly rolled out? Or do you think that there will be continuing Brexit friction and this could impede its climb upwards?
Yeah, I think there are arguments on both sides, but I do lean more towards a positive short-term outlook for the UK. I think there's some of the points benefiting the UK is partly the vaccine rollout, as you highlight. We've seen retail sales figures recently being quite tough. But interestingly, what we've seen is retail sales numbers are low, but online sales have been very high. Now, that's unsurprising when the world is in lockdown, or the country is in lockdown. But what it says is that consumers don't appear to be retrenching and saving for a rainy day. They're willing to spend online. Maybe when they reopen, all of that enforced saving that many people have had to undertake, that replaced the furlough replacements from governments, putting a little bit more money in people's pockets than if they'd have just been made redundant. Maybe some of that will flow through, and we'll have a little bit of a consumer boom in the short term. And I think what's interesting from the UK, we've had all of 2020 largely in lockdowns. There's been a bit of a pent-up demand from that. But even before that, the sense was there was a lot of pent-up demand from business and consumers around Brexit. So 2018, 2019, pent-up demand that was expected to be released in 2020, that's been delayed because of COVID. So for the UK specifically, there are a lot of reasons to think that pent-up demand could spur the UK economy. In terms of the market, as you highlight, it is very cyclical, particularly given its exposure to miners and oil and gas and financials. And actually, the majority of the UK market actually derives its revenues from overseas. So that large cap UK stocks have a very international flavour. So in that sense, the market is a geared play on global economic recovery. There's also reasons to be optimistic domestically. Of course, some frictions around Brexit could cause issues. I think we're starting to see that already, in that the deal done at the end of last year was largely around goods traded at the border. And we still need to resolve some of the services issues. We've already seen that with, for example, Eurozone share trading moving from primarily in London over to Amsterdam. So there's almost certainly going to be friction, but I think it might be less than many people worried. One of the unfortunate benefits that the market has found, if we'd have had a bad Brexit breakup, say in 2020, and we didn't have COVID, then all of the efforts by the government might have caused trouble for the UK market. But because there is now the cover of COVID-19 and monetary and fiscal stimulus is happening all over the world, the additional stimulus that might be needed because of changes around Brexit basically is a drop in the ocean compared to what's going on now. So it would have been different if the UK was having to deploy these measures in isolation in normal economic times. Actually, the impact of COVID means a lot of the sting has been taken out of that potential tail.
Okay, Ben, this is the stuff we want to know. Give us your top 3 tactical opportunities and maybe some fund suggestions as well within those areas.
Oh, I couldn't possibly tell you that. No, I can. So 3. I guess they're not all perhaps as tactical as you might think, but I think, as I said, with inflation rising, I would be looking within my fixed income exposure, maybe to add some tips exposure. So US Treasury inflation protected securities. An easy way to do that is through something like an ETF. So I looked to sterling hedged. Just one idea there. I mean, certainly what we're using is the Lixor US Tips sterling hedged ETF. So it gives you quick exposure. You hedge out the currency, particularly given the sterling strength. That can certainly be a factor. I guess one of the other areas I would probably flag is, we talked about it before, but I'd be looking to maybe add to UK equities broadly. I think it's an area that could sort of benefit. It's a slightly difficult one. If you want the UK and you want sort of some of that value exposure, dare I say, you could think about something like a FTSE 100 tracker if you want broad exposure. My preference in the portfolios, and it blurs the line between a sort of tactical and strategic. It's tactical in the sense of it's increasing UK equity exposure. It's strategic though, because my general preference in our portfolios is for longer term exposure, strategic exposure to managers. So there, funds such as Lion Trust Special Situations is very good, as is Even Load Income. Both of those are sort of strategic holdings for me, but I think increasing those on a tactical basis just to get more exposure to UK equities is a good idea too. And in terms of maybe a third idea, gearing up for potential economic recovery, though it does take a bit more in terms of risk appetite. But I like small caps. I think small caps could be a good place to be on a tactical but multi-year view to play this economic recovery. Obviously, areas that have struggled a little bit. And again, I'd probably look to the UK and perhaps the two funds that I'd highlight within that would be Tellworth UK Smaller Companies. That's run by Paul Marriage of Schroeder fame. So you may not have heard of the fund, but certainly Paul Marriage is one of the best known and longest standing high quality managers in that space. Or alternatively, River and Mercantile have a very good UK Smaller Companies fund as well. So I think those could be interesting ideas too.
Okay, great stuff. So we've got some inflation protected US government bonds, some UK equities in both the larger and smaller cap space. Ben Seeger-Scott, thank you very much.
Pleasure.
Well, as ever, that was incredibly insightful and interesting from Ben. What did you think, Marcus?
Yeah, I thought there was quite a lot of interesting things he said there, really. I mean, one of the things that's quite important to remember is that markets are forward-looking, and what he thought was that there is quite a lot of optimism, it seems, in the price there, that markets are pricing in a quite a positive trajectory for our economic recovery. But of course, the economics of today tell a different picture. We are still in the middle of a lockdown. We have shut down our economy for a year, and there could be these near-term risks of rising unemployment and businesses failing, that as these bits of news start to come out, that could surprise investors, on the downside. It's worse than they thought, which could affect sentiment in markets, and therefore, you could see some drops off the back of that. So don't forget the risks that are still there in the equity markets, even though they are appearing quite optimistic at the moment. I also thought it was interesting that he, talked about there is a realistic prospect of inflation and economic growth, so the reflation trade wasn't a bad idea, and that, if you're looking to protect against inflation a little bit in your portfolio, that things like real assets have traditionally done quite well in that respect. So I thought that was interesting. And finally, just his positivity on the UK, really. It was an interesting point around the fact that we've got pent-up demand, not just from COVID, but from Brexit before that, which is quite a positive for UK markets. And also that our markets are quite globally exposed. And as I mentioned before, they've got a bit of a value tilt. There's a bit of an economic sensitivity within them that is, that can be quite a good place to be as and when the economy recovers. So some interesting stuff that he said there. We're going to look at it in more detail in my article in the next upcoming guide, which is released on the 26th of March.
Well, we thank Ben for his time. And next week, considering inflation and Ben's comments around real assets being the place to be, as luck would have it, next week we are talking property and peer-to-peer investing. Join us again then, but until then, goodbye.